September 28, 2022. Britain's government bond market, the place investors park money when they want to sleep at night, was on the verge of breaking. Pension funds were dumping gilts. Prices were collapsing. Yields were exploding. And the Bank of England suddenly stepped in with an emergency rescue plan of up to £65 billion. Not to save a reckless hedge fund. Not to bail out a rogue bank. But to stop retirement money from detonating the system. So here's the uncomfortable question. How did the safest money in Britain become the most dangerous thing in the room? To understand how this happened, you need to start with something deeply unexciting: pensions. Not hedge funds. Not crypto bros. Pension funds. British pension funds promise fixed payments decades into the future. That means their biggest fear isn't market crashes, it's interest rates moving the wrong way. If rates fall, their future obligations suddenly look much larger. So, the industry embraced a strategy called liability-driven investment, or LDI. On paper, LDI sounds sensible. You buy long-dated government bonds, gilts, and use derivatives to hedge interest rate risk. When rates move, your assets move with your liabilities. Problem solved. Except there was a catch. To make this strategy capital efficient, pension funds used leverage. They didn't fully pay for these hedges up front. They borrowed. They used repos. They posted collateral. That freed up cash to invest elsewhere while still claiming the fund was safer. It worked beautifully as long as markets stayed calm. Think of it like this. You buy insurance on your house, but instead of paying a fixed premium, the insurer can demand cash instantly whenever the weather forecast changes. If you don't pay within hours, your house gets sold. That's how margin works. For years, interest rates barely moved. Models said gilts were liquid. Stress tests assumed orderly markets. Everyone hedged the same way. Everyone trusted the same math. But when risk is engineered out of sight, it doesn't disappear. It just waits for the one moment when everyone needs cash at the same time. And in September 2022, that moment arrived. For more than a decade, LDI looked like a financial miracle. Pension trustees loved it because funding ratios stopped swinging wildly. Regulators tolerated it because, on paper, risks appeared hedged. Consultants sold it because it made numbers behave. And best of all, leverage made it feel almost free. By using derivatives and repo borrowing, pension funds could control massive interest rate exposures with relatively little cash. The logic was seductive: hedge the boring stuff. Then use the freed-up capital to chase returns elsewhere. Private equity. Credit. Infrastructure. Yield. Congratulations. Your pension is now safer because it's borrowing. For years, nothing went wrong. Interest rates moved slowly. Gilt markets stayed liquid. Margin calls were small and manageable. When collateral was needed, it could be raised quietly, without selling core assets. The models loved this world. Volatility was low. Liquidity was assumed. Stress tests looked backward and saw calm. But there was an unspoken assumption baked into every spreadsheet: that government bonds would always be easy to sell. Here's the paradox. The more funds adopted LDI, the more they behaved the same way. The more they hedged, the more crowded the trade became. And the more crowded it became, the more fragile the system grew. If everyone is hedged in the same direction, who's left to buy when prices fall? It didn't feel like risk. It felt like professionalism. It didn't feel like speculation. It felt like responsibility. And that's what made it dangerous. Because this wasn't greed chasing explosive upside. This was caution amplified by leverage quietly wiring the system so that a single shock could force everyone to run for the exit at once. The boom didn't look like a bubble. It looked like stability. And stability, in finance, is often the most misleading signal of all. The crack didn't start inside pension funds. It started in politics. On September 23, 2022, the UK government unveiled a so-called mini-budget. End quote. It promised large, unfunded tax cuts, more borrowing, and a casual attitude toward deficits all at once. Markets reacted instantly. Gilt prices fell. Yields surged. And inside LDI strategies, alarms began to ring. Higher yields meant derivatives lost value. That triggered margin calls, urgent demands for cash collateral. Not next week. Not next month. Now. At first, funds tried to handle it quietly. They sold liquid assets. They raised cash. They met the calls. But yields kept rising. And here's the fatal design flaw. To raise cash, LDI funds sold the very thing the system depended on, long-dated government bonds. Selling gilts pushed prices down further. Lower prices pushed yields up further. Higher yields triggered even more margin calls. A feedback loop had formed. One central bank blog later estimated that forced selling by LDI funds accounted for roughly half of the collapse in gilt prices during those days. This wasn't panic driven by fear. It was panic driven by math. Risk models were doing exactly what they were programmed to do. They just hadn't imagined a world where everyone needed liquidity at the same time. The cracks were no longer theoretical. They were spreading hour by hour. By the final days of September, the market stopped behaving like a market. Gilt yields weren't just rising, they were lurching. Prices weren't adjusting, they were gapping. Liquidity wasn't thinning, it was vanishing. Inside pension funds, the calls kept coming. More collateral. More cash. Fewer hours. Funds sold gilts to survive the margin calls. Those sales pushed prices lower. Lower prices triggered even bigger margin calls. Up. Down. Faster. Louder. This is what traders call a doom loop, a system feeding on its own damage. Normally, falling prices attract buyers. But here, the natural buyers were the sellers. Everyone who held long-dated gilts was either leveraged or terrified. At this point, the problem was no longer pensions. It was market functioning. On September 28, the Bank of England stepped in. Not quietly. Publicly. Forcefully. It announced emergency purchases of long-dated government bonds up to £65 billion if needed to restore orderly market conditions. That phrase matters. Central banks don't talk about order unless disorder is already winning. When the lender of last resort becomes the buyer of last resort, it's a signal flare. The exit doors are blocked. The fire alarm is already ringing. The intervention worked, yields fell. Prices stabilized. And margin calls eased. But the message was unmistakable. This wasn't a hedge fund blowing itself up. This was retirement money dragging the entire bond market toward the edge. And without intervention, it would not have stopped on its own. The immediate crisis faded quickly. Yields fell. Margin calls slowed. The doom loop loosened its grip. But nothing about this episode was resolved. And friends, what the intervention really did was expose a fault line running straight through modern finance, non-bank leverage. Pension funds weren't regulated like banks. Yet they were using bank-like borrowing, relying on constant liquidity, and assuming the state would step in if things broke. And step in it did. The Bank of England's purchases were indemnified by the UK Treasury. Which means, in plain English, the public backstopped the rescue. Not because pensions were evil, but because letting them fail would have taken the entire bond market with them. Parliament launched inquiries. Regulators demanded larger collateral buffers. Stress tests were rewritten to imagine markets that don't stay orderly. But here's the uncomfortable truth. No one went to jail. No fund manager lost decades of bonuses. And the system quietly moved on, slightly reinforced. But fundamentally unchanged. This wasn't a casino collapse in London or New York. It was retirement promises trembling in real time. And it raised a question that still doesn't have a clean answer. When safe institutions use leverage, who is really carrying the risk? This story doesn't end with villains in handcuffs or villains exposed on magazine covers. It ends with something quieter and far more unsettling. Leverage didn't eliminate risk. It hid it, synchronized it, and demanded cash at the worst possible moment. Risk management became risk amplification. Safety became fragility. And when the math finally broke, The system reached for the same solution it always does: the public balance sheet. So the next time finance promises you something is low risk, here's the real question you should ask. If this breaks, who's paying for it?